Welcome to the Techno Fundamental Report for April the 4th. Techno Fundamental comes from a book written by Nicholas Darvis back in the 1950s. He was one of the first publicly known successful investors that used technical analysis for his work, and he basically determined his analysis by trial and error. The book is about a guy that basically starts with nothing, builds a substantial portfolio, and he found that techno-fundamental analysis was the way to go. So I hate to admit it, but I'm somewhat addicted to technical analysis. I think it's very important. So let's just look at a report I saw on how you can define technical analysis. There are three assumptions. One, market actions discount everything. Price should reflect all available information. To a technician, how markets are moving is more important than why. By observing price and other tools, a technician can assess the trend and estimate future price action. So the key word here is trend, because with the style of technical analysis that I've adopted is called trend following. Does the market discount everything? I think it does. The information is so readily available now with the internet, etc. Used to be the old days, you'd read the newspaper. But the bottom line there is that if you use Tesla as an example, we started to sell Tesla back in 2020 and 2021, and we didn't know, we were very uncomfortable because we had a very large taxable profit in the stock. We were very uncomfortable selling it, but the market knew something, and here we are roughly 3-4 years later, and EV sales are falling off pretty heavily. And in fact, Tesla's numbers came out the other day on deliveries, and they were not good. In fact, there's a company called Fisker that has a very nice car called the Ocean. It retailed originally for $70,000. They are now down to about $35,000 on that car. So it just kind of shows you that the market was discounting the EV thing 3-4 years ago. So you never know. It could be weeks, it could be months, it could be years. Prices move in trends. You might want to pause your video player and read the rest of this, but then history repeats itself. Buffett said that history may not repeat itself, but it sure rhymes. Now, Jesse Livermore, over the Easter break, I decided to reread How to Trade in Stocks by Jesse Livermore. It's a very short book. I recommend it highly. Livermore, to understand Livermore, he had a very unique strategy now, and I'm not saying that his strategy would work in today's times. In fact, I really don't think they would. But he was very successful in trend following and following the markets. He was somewhat of a technician himself. To put it in perspective, in 1925, he operated between 1920 and 1940. In 1925, his portfolio got up to $50 million. And then by 1929, he had his portfolio up to $100 million. And I think it's important to realize in 1929, a loaf of bread cost 20 cents, and 31 it cost 8 cents, 39 cost 9 cents. That's deflation, by the way. So I took his book, and I thought that it was just really important to pull some pages from the book and share them with you. Now, I could share 10 pages or 20 pages easily. I'm just kind of trying to give you the shortest version as I can. He says, profits always take care of themselves, but losses never do. So you need to guard yourself against losses by using a stop loss. Now, in some cases, you want to use a stop gain even, where you have a big gain in a stock and it's starting to break down. So you have to have insurance is what he boils down to. He says, as long as the stock is acting right, the market is right, do not be in a hurry to take a profit. In other words, let your winners run, cut your losers quick, is really the general idea there. But like I say, pause your video player and read these pages here. He says, how often do you hear an investor say, I don't have to worry about fluctuations of margin calls. I never speculate. When I buy stocks, I buy them for an investment. And if they go down, eventually they will come back. Well, great idea, because if you go back and you can recall many years ago, it was considered safe to have your money invested in New York, New Haven, and Hartford Railroad than to have it in a bank. On April 28, 1982, New Haven was selling at $255 a share. You come on down here and you find out it's now down to 50 cents a share in 1940. So, the whole idea here of buy and hold, it works some of the time, but some of the time it doesn't. So you have to realize that. And if you get a buy and hold and let that winner run, that is fantastic. Here's another one here. Never confuse, profits take care of themselves. Losses never do. Never confuse this approach of letting a position ride with the buy and hold forever strategy. I do not and never have blindly bought and held a stock. So, if you bought, it's going down here, it says to buy and hold blindly on the basis that it is a great company or a strong industry or the economy is generally healthy is, to me, the equivalent of stock market suicide. So basically, what we have to understand here is that everything's going to work out. We buy, generally speaking, we try to hold our portfolio in the 5 to 10 stock range. Sometimes we get up to 15 stocks, but if any of those stocks don't work, we take immediate action. Now, I thought this was interesting. Steve Eisman, now I don't know if y'all remember Steve Eisman, but he was one of the main characters in the movie The Big Short. He was the one that was out there warning Bear Stearns and Lehman Brothers that there was a major crisis. But anyway, he was interviewed recently, and he says, Steve Eisman says the Fed shouldn't cut rates, risk creating a stock market bubble if it does. I have to agree with him. I think that the market is handling rates quite well. The thing about interest rates we have to remember is it's the direction of the rates. It's not the actual absolute level. So in other words, if you look at where we've been in the last, say, year, interest rates are basically at the same place. They're moving sideways. Now, if you look at our power index, you can see here we're in a downtrend on the power index. And what that power index does is it measures the rate of change over 125 trading days, which is roughly 6 months. And right now, the power index is a minus 9.5. So basically what it's saying is that over time, because this indicator uses time, over the last 125 trading days, interest rates have basically gone nowhere. So interest rates are stable, stock market's making new highs, employment levels are fine, no recession. So I think Eisman is right. I think the Fed should just sit tight, but who knows? Now, he also mentioned that he thought the chairman, Jerome Powell, is somewhat of a dove and really doesn't want to raise rates. So look, I'm going to move quick here because this market is really, starting to have some, changes of character here. We're starting to see more activity in the energy stocks. We're seeing more activity in the financials, and we're seeing more activity in things like home building and industrial stocks. So here we have the NASDAQ. Now, what I have here is the 10-day moving average and the 21-day moving average and the 50-day moving average. Now, the way we look at this is that this is a very strong uptrend. So what we're looking for is some type of violation in the trend. And the way we would see a violation would be is if we break down below these moving averages. It could be the 50-day, it could be any of these. If you break down below them and then the following period or periods, you break below this low, that is a violation. So you get the break, and then you get the violation. Well, you can see with the NASDAQ, no violation. It's definitely in an uptrend. This is a short-term analysis, by the way. This is not long-term. We'll look at that in a minute. So here's the mid-cap stocks. You can see the same concept. We got the break, no violation. So the mid-caps are holding up. New York Stock Exchange, same thing. We've got the break, no violation. We're just getting a correction in here and a change of leadership, actually. Small caps, which are very important. But realize these are low-quality companies. Not about 70% of the small-cap indexes, the companies don't make money. And then you've got a lot of the regional banks in here, and then you've got a lot of small oil stocks. So the index is kind of deceptive, but I don't think you should shy away from a small-cap opportunity because if the company is fundamentally sound and making money, it would be the exception. But anyway, you can see here we got the break, no violation. So actually, the small caps are holding up. Here's S&P 500, same thing, break, no violation. So overall, things look pretty positive. Now, on the longer-term graph, which is where you use a 200-day moving average, the primary trend is up on the S&P, and the primary trend is up on the NASDAQ. We're looking good there. Here is some stocks we can look at. I just thought we'd take a snapshot of about 3. This is to show you the change in leadership we're seeing here. This is coal, CNX Resources, coal stocks, all right? Well, we got a nice base that built here. You had a gap up that started that basing process, which was an ascending base. You've got another gap up here and a very strong uptrend. Now, I'm not saying you should run out and go buy coal stocks, but I'm saying this is the change that the market's going through. It's less technology. Technology is kind of taking a breather here. Here's Diamondback Energy, a very successful Permian Basin driller. There's all kind of rumors out there about an acquisition and so forth, where they might be acquired. It could be. But the point is, you can see the power of the uptrend. Also, if you look at how I've got the graph set up, the trend meter's in the green, moving above the moving averages. The moving averages are in a positive uptrend. You've got good volume patterns here, not a lot of selling. Here's your relative strength 1 positive, relative strength 2 positive. So again, I'm just saying we have actually taken some positions in the energy area. Very small, but we're taking a look at it. Here's a stock we did buy as well. I have to disclose this. This is Beacon Roofing. Again, housing stocks are looking good. The millennials need houses. There's a shortage of houses. New construction, the market's discounting something here. And so with Beacon Roofing, you got this nice base, a breakout into an uptrend. You got the trend meter in good shape, good volume patterns. In fact, you had a nice pattern here just 4 days ago. Volume, relative strength 1 positive, relative strength 2 positive. So what we're trying to say is don't become complacent here. We may see some major changes in this market, and we'll just have to see. I don't think technology is dead. I just think it needs to slow down a little bit. Thank you very much. Have a good day.